In this video, we learn the underlying concept of the Miller and Modigliani, that is the theory of capital structure. We cover the theory without corporate taxes, published in 1958. The theory with corporate taxes is covered in the next video of this series. After World War II, there was a huge gap between demand and supply, and firms experienced tremendous growth. Financing the growth was important, and debt was one of the options. This gave rise to the question that whether debt or borrowing was good for corporate firms. In other words, as maximizing value is the cornerstone of everything in a corporate firm, does debt create value? Were the first to respond to this question. Their first paper is known as Without Taxes, which was published in 1958, and that we cover in this video. Their second paper, which is known as with Taxes, and it was published in 1963. We cover this in our next video. Responded and concluded that debt does not create value if there are no corporate taxes under certain assumptions that included that the business risk and earning power, that is efficiency of the firms in utilizing economic resources, is the same. Both individuals and corporate firms are able to borrow and lend at the risk-free rate unlimited amount of money. There is zero growth, that is all earnings are paid out as dividend. So we have 100% dividend payout and 0% retention ratio, which also implies that the net investment in operating capital is zero. There are no transaction costs, no restriction on short sales, and the ability to buy fractional securities, that is being able to buy 0.5 share of a company. Keeping these assumptions, we can show that debt does not create value. There are two basic propositions of the theory with zero taxes. The first proposition is that the value of a levered firm is equal to the value of an unlevered firm. The second proposition is that the WACC of a levered firm is equal to the cost of unlevered equity of the unlevered firm, which is also equal to the WACC of the unlevered firm because there are no debt in the capital structure of the unlevered company. So basically, the levered company here has borrowed money and has debt in its capital structure. The unlevered company is 100% financed by equity. The argument is that if there are no corporate taxes, the value of a levered firm should be equal to the value of an unlevered firm. And in that case, the WACC of the levered firm should equal the cost of equity of the unlevered firm, which is also equal to the WACC of the unlevered firm as it has no debt in its capital structure. Now, to prove these two propositions, let's have these two hypothetical firms here, firm U and firm L. Both the firms have $20,000 as capital. So the capital base of both the firms is the same. However, firm U, which is an unleveraged firm, has no debt in its capital structure and is 100% financed by equity. Firm L, which is a leveraged firm, has $10,000 in debt that pays 12% interest on it, and then equity of $10,000. So firm L, the leveraged firm, is 50% equity and 50% debt finance. Now we also assume the tax rate to be zero as we want to prove the two propositions of theory with zero taxes. We are keeping the earning power of the two firms the same, so we are assuming that earning before interest and taxes for both the firms, that is the leveraged firm L and the unleveraged firm U is $5,000. We can see here that EBIT and NOPAT are the same. NOPAT is net operating profit after taxes. NOPAT is calculated as earning before interest and taxes into 1 minus the tax rate. Let me show you this here. As the tax rate is 0, so NOPAT will be equal to earning before interest and rate multiplied into 1. So we will have EBIT equal to NOPAT in the case where tax rate is 0. As we can see here, the return on invested capital for both the firms is the same. That is, both the firms have the same basic earning power. This is obtained dividing the NOPAT by the total capital. So $5,000 divided by $20,000, that gives us a return on invested capital of 25% for firm U as well as for firm L. Now here we have calculated the net income for both the firms using the data from the previous slides. So earning before interest and taxes is the same for both the firms. However, the unleveraged firm U has no debt, so it is paying no interest here. Firm L, which is the leveraged company that has 50% debt and 50% equity in its capital structure, will pay $1,200 on the $10,000 of borrowing at 12%. So the net income of firm U is $5,000 and the net income of firm L is $3,800. The cash flow to the shareholders in firm U is $5,000 because there are no creditors and no interest payment is required. So all the earnings are paid out as dividends to the shareholders in firm U, and that is also equal to the total cash flow, which is the free cash flow available for distribution to shareholders, which has been in this case paid out as dividend. Then firm L has $3,800 paid as dividends to its shareholders and $1,200 paid as interest to the creditors on the borrowing. So its total cash flow is also equal to $5,000. So we see that both the firms have the same cash flow. The only difference is that all the earnings are paid as dividend to shareholders in the unleveraged firm and only $3,800 are paid as dividend to the shareholders in firm L. It is because $1,200 needs to be paid as interest to the creditors in firm L. The total cash flow here is the free cash flow to the firm. It is that cash flow which is available to the firm after meeting its short-run and long-run business requirements, and this can be used to pay dividends, interest, buy back shares, retire bonds, or buy other companies. Mathematically, the free cash flow to the firm formula is given as free cash flow to the firm is equal to NOPAT minus net investment in fixed assets net investment in working capital. We first calculate the cost of unlevered equity, which is net income of the unlevered firm divided by the equity of the unlevered firm. Now, because there are no interest expenses and taxes, net income of the unlevered firm is equal to earning before taxes, which is also equal to earning before interest and taxes. Also, the total assets are equal to the total equity because all the assets are 100% financed by equity. And we know the growth rate is 0, So the formula for the free cash flow to the firm will reduce to net income of the unlevered firm because there are no interest expenses. So NOPAT is exactly equal to net income. And because there are no taxes, so we can see that NOPAT is also equal to earning before interest and taxes. Using the figures from our example, we estimate the cost of unlevered equity in this case to be 25%, which is also equal to the return on invested capital of the unlevered firm, as there are no debt in the capital structure. The free cash flow to the firm, as discussed, will be equal to the net income of the unlevered firm, which is $5,000 in this case. The basic principle in valuation is that the value of anything is equal to the present value of all its future cash flows discounted at the required rate of return. So in our case, the future cash flows of the unlevered firm are equal to the net income of the unlevered firm, and the cost of equity we estimated here is the discount rate that we need to use to value the unlevered firm. Because there is no growth, so we don't have any growth rate mentioned in the numerator here or the denominator here. It's a perpetuity where we expect the company to earn each year a cash flow of 5,000 for indefinite future. The result is we have $5,000 as the cash flow divided by 25% as the cost of unlevered equity, which is equal to $20,000 as the value of the unlevered firm. Now we have to prove that the value of the unlevered firm should be equal to the value of the levered firm using the numbers we have assumed for this example. However, before we do that, we will turn our attention to proposition 2, and there we need to estimate the cost of capital of the levered firm so we can value the levered firm and compare against the unlevered firm in proposition 1. In proposition 2, we have the WACC of a levered company equal to the cost of unlevered equity, which is also equal to the WACC of the unlevered firm because there is no debt involved in the capital structure of the unlevered firm. So we have this expression where WACC of the levered firm is equal to the WACC of the unlevered firm, as there are no debt and no taxes. Now, the WACC of the levered firm is given as a weighted average of the cost of debt and the cost of equity of the levered company. The weight of debt and the weight of equity in the capital structure of the levered company are obtained as market value of debt divided by market value of the firm and market value of equity divided by market value of the firm. Now, we are assuming here that there are no taxes and that there is no value created by the use of debt. So the value of a levered company should be equal to the value of an unlevered company. So the value of the unlevered company is 20,000 as we saw on the previous slide. Given this, the market value of debt here is equal to the book value of debt, and the market value of equity here is equal to the book value of equity. So if we divide these by the market value of the firm, we get the weight of equity equal to 50% and the weight of debt equal to 50%. From the WACC formula here, we already know KD is equal to 12%, and we have got the weight of debt and the weight of equity calculated here 50% each. The only missing element is the cost of levered equity. So that we calculate here, the cost of levered equity is equal to the net income of the levered firm divided by the equity of the levered firm, which can also be represented mathematically as the cost of unlevered equity plus the cost of unlevered equity minus the cost of debt into the weight of debt divided by the weight of equity. You can also take the numbers here, for example 10,000 divided by 10,000, which will give you 1, or you can do 0.5 divided by 0.5. I have put the value of debt and the value of equity here. If we use these figures in the formula here, cost of lived equity is equal to 38%. And if we put 38% into the formula for the wake of the lived company, we get the wake of the lived company equal to 25%, which is exactly equal to the cost of unlived equity, which was 25%. Under the given assumption, we prove that the cost of unlevered equity is equal to the WACC of the levered firm. That is exactly what proposition 2 states. Note that how this WACC formula here and here does not have the 1 minus t element because we are assuming taxes to be 0. So we don't calculate the cost of debt adjusted for taxes, or rather we are assuming taxes to be 0. Now that we have proven proposition 2, which was that the WACC of a levered firm should be equal to the cost of equity of an unlevered firm, we turn our attention to the valuation of the levered firm. The value of the unlevered firm we already know is 20,000, and we estimated that by discounting the free cash flow to the unlevered firm by the cost of unlevered equity. And the free cash flow of the unlevered firm from the previous slide was $5,000, and we divided that by 25% and we got 20,000 on the previous slide. However, for the unlevered firm we did not have the WACC. So now we have calculated the WACC of the levered firm and we have confirmed that it is 25%. So we know that the total cash flow, that is the free cash flow for the levered firm and the free cash flow for the unlevered firm, are the same from our previous slides. So we divide $5,000, which is the free cash flow to the levered firm, by 25%, and this gives us 20,000. So we see here that the value of a levered firm is exactly equal to the value of unlevered firm, provided there are no corporate taxes and the assumptions as we have taken in line with theory are kept. Now note that the WACC of the levered firm is equal to the cost of unlevered equity, which is also equal to the WACC of the unlevered firm. So you can replace this KU with WACC of the unlevered firm because they are both the same. These two figures here for the levered firm and the unlevered firm, that is their valuation, support the argument of that if there are no taxes and provided the assumptions hold, the value of a levered company is equal to the value of unlevered company, and hence there is no value created by borrowing, that is debt. We can also prove that the value of a levered firm is equal to the value of an unlevered firm by segregating the total value of the firm into the value of equity and into the value of debt. The value of equity is equal to the free cash flow to shareholders of the levered firm divided by the cost of levered equity, and the cash flow to the creditors of the levered firm divided by the cost of debt of the levered firm. The cash flow to the shareholders of the levered firm is equal to the dividends paid, which is equal to the total net income, that is $3,800, and we already know that the cost of levered equity is 38%. So $3,800 divided by 38% gives us the value of equity equal to $10,000. The value of debt will be the interest payment made each year divided by the cost of debt. So $1,200 divided by 12%, that gives us the value of debt equal to $10,000. So 10,000 plus 10,000 is equal to $20,000. Again, we see that the value of the levered firm is equal to the value of unlevered firm, consistent with theory with zero taxes, which is arguing that the value of a levered firm should be equal to the value of unlevered firm. That is proposition number 1 when there are no corporate taxes. We have proven both the propositions of theory using our numerical example. In the first case, we proved proposition 2 where we concluded that the WACC of the levered company was equal to the cost of equity of the unlevered firm. In the second bit, we learned that the value of a levered firm will always be equal to the value of unlevered firm provided there are no corporate taxes. The theory was severely criticized for its unrealistic assumptions including zero corporate and personal taxes. Though in reality, in some cases, both corporations and individuals may be able to lend at the risk-free rate, but their ability to borrow at the risk-free rate is not realistic. There are now mobile apps that provide the facility to trade in the market with zero transaction cost, but that doesn't mean that transaction costs effectively are all zero. Similarly, the ability to trade fractional shares was unrealistic 20-30 years ago, but now it is a reality. There are firms that offer products that allow you to invest in fractional shares of different companies. Though some of the unrealistic assumption criticism may have been mitigated nowadays, the main criticism is still there, and that is the zero corporate and personal taxes, because it doesn't allow to account for the value of the tax shield on interest payment on borrowing by the firm. And this is what addressed in their second paper, which is known as the with corporate taxes, published in 1963. We cover that in our next video.